We're joined by Jonathan Garner to talk about emerging markets and where India stacks up as far as the emerging market pack is concerned from the sidelines of the Morgan Stanley conference, which is happening in Mumbai right now. Jonathan, evening. Thank you so much for talking to us today. Talk to us about how the emerging market scenario is looking right now. As far as the valuations go, because we have rallied quite a bit from the lower levels, how do valuations stack up right now, Asian emerging markets?
Yeah, so if you look at emerging markets overall, they're trading about 11.5 times consensus forward price to earnings, which is almost exactly in line with sort of 5-year average levels. They were cheaper than that last October when we turned constructive. That is, in aggregate, as always, there's a large dispersion. And last October, the markets that were particularly cheap were Korea, Taiwan and China.
What's your MSCI emerging market target now over the next 12 to 24 months?
So we just published on Monday our June 2024 targets, and that's 1,100 for the MSCI EM index. So when we published, that's around 12% or so upside, and a slightly more bullish view on Japan with a TOPIX target of 2,400. And the Japan market is the one that's actually making most progress at the moment and where we've been raising our target price this year.
That's correct. It has surprised many the way Japan has come back after a very, very long time. 1990 is the highest levels we've seen on that index. Talk to us about quality of growth as somebody who looks at emerging markets very closely. If we were to look at pockets, India, China, Japan, Indonesia, how are you looking at the quality of growth happening here, or rebound or recovery, if I may say that?
Well, for stock markets, what matters is that any kind of GDP growth outlook translates into a good corporate profits outlook, and that's to do with business execution. Certainly, India and Indonesia will likely have the strongest GDP growth in emerging markets this year at around 6% in each case. And both those markets have a reasonably good track record of delivering dollar earnings per share growth that's better than the average in emerging markets. But Japan's quite different. It's not really a domestic GDP growth story. It's the ability of the gigantic Japanese exporting companies to do well in a global environment. And that's to do with their technology, their productive capex, and the advantage they get from a weaker yen. So there are different reasons why we prefer markets that we do have as our picks. Korea and Taiwan is a bit of a mixture, but again, they tend to be more export earning in terms of the stocks. And we are very excited about the semiconductor and technology cycle picking up from a low ebb late last year and heading to a much better environment by the time we get towards the middle of the next global economic upturn in 2025.
Jonathan, I'd also like to, before we talk about sectors, how does India stack up in the Asian emerging market pack right now, quality of earnings, quality of growth wise? And valuations, of course.
Well, the earnings growth outlook is good. Our colleague Ridham Desai has a convincing case that earnings compound annual growth rate can be around 20% plus on, say, a 3-year forward basis. And the companies are executing well. The issue is really around valuations. So last October, when Korea, Taiwan and China were so cheap, the Indian market, if you look at, say, Sensex on a forward PE basis, was at very high valuations. And MSCI China almost 23 times forward PE, a near record valuation premium to Korea or China. Now that gap closed through the Indian market having a relatively poor performance late last year and early this year. So by the time we got to the end of March, we actually upgraded India from an underweight to a neutral, and it's now right at the top of our neutral recommendation, albeit that the valuations are about 1.6 times that of overall emerging markets. That's still above long-run average premium. The Indian market typically enjoys a premium to other emerging markets, but last October it was at a record, and that was too rich.
Right. If we were to talk about flows, I mean, you speak with some of the biggest global asset allocators who are looking at good opportunity. When you're having your discussions, what is the sense you're getting on flows? Which are the kind of markets where flows will actually go? as we go ahead and the rate cut cycle starts maybe in the next 6 to 8 months ahead?
Well, it's a complex situation. Yes, you're right that interest rates are an important part of it, but geopolitical risk is something that investors are also very focused on because that affects the cost of equity or the valuation. And certainly what we're seeing is that for Japan in particular, that geopolitical risk situation is probably at the margin helping drive a wide range of investors towards Japan, both developed investors and Asia specialists. Whereas for China, really, ever since February and with the further deterioration in the geopolitical risk environment, particularly the relationship vis-a-vis the United States, that risk premium has been built back into the China market. It does leave China, though, now trading close to an all-time low valuation relative to other emerging markets. So we have to think about a multiplicity of different features when we put together our individual market targets and also our target for the asset class overall.
Jonathan, I'm really happy that you brought up that point of China, because there's a China versus India equation always playing out as far as emerging markets and watchers, at least here, are concerned. We saw a lot of money chase Chinese stocks because they had gone way below their fair value earlier, a few months back. But that seemed to be reversing. Do you see that more juice in that trade on valuation, quality of earnings and growth? The flows may continue to come out of China and go to India, or you think bulk of that trade is already wound up?
Well, as I just mentioned, the China market is back to being exceptionally cheap versus other emerging or Asian markets. I wouldn't really characterize it as flows from China towards India. If anything, what we've seen more is flows from China, in fact, towards the Japan market, which traded all-time high trading volumes just 1 week ago. And as you mentioned right at the start of this interview, is now broken into effectively new territory as an index in terms of performance. So again, for China, it depends on the evolution of growth and geopolitical risk, but you have a large valuation cushion, so quite a lot of the bad news is in the price now. I should also touch on Latin America, EMEA, and Southeast Asia. These are also, in aggregate, quite large constituents of the EM index, but they tend to be more affected by commodity prices, which is an area that we've not been bullish on at Morgan Stanley this year, either in energy or diversified mining or mining-related areas like iron ore, for example. And so for us, our underweights are sitting more within that group, some of which were defensive, let's say 12 to 18 months ago. So right now, other than Japan, our core picks in the Asia ex-Japan universe are Korea and Taiwan, the hardware-related parts of the market. And all of these markets, Japan, Korea, Taiwan, as well as India, they are actually oil and commodity importers. So they're benefiting from the weakness that we're seeing this year in commodity prices.
In fact, you preempted my next question. I wanted to scratch that point of, the sectors a little more. Taiwan clearly is one market which is tilted in favor of hardware, especially chips, etc. India is trying to own, up their own game as far as electronics manufacturing is considered, hardware is considered. And then, of course, there are commodity consumer sectors which benefit. What are your own top 3 or 4 sectoral bets in this entire region?
So Korea and Taiwan on the semiconductor technology hardware side, particularly the Korean memory names and the leading foundry names in Taiwan. But there are also other subcomponents of those tech sectors that actually do feed into this demand for AI servers. That is clearly the next thing in that space. I think if you look, yes, at final assembly of technology hardware products here in India, that's an exciting development in terms of inward FDI. But within the listed Indian equities universe, we prefer financials and consumer discretionary. And our colleague Ridham Desai is also constructive on parts of industrial. So it's got that domestic cyclicality component to it, which is also what we like within the Indonesian market. So those are some of the key areas of preference.
Jonathan, what are some of the risks you are assigning for this rally, the hypothesis, for equities in the region? Also, the main hypothesis that rate cut cycle may actually start in the next 6 months. What if the rate cut cycle gets delayed as some certain section of the market actually is feeling that it's not in a hurry, that rate cuts may actually not start in the next 6 to 8 months, and data may start deteriorating once again. How do you see some of those risks or any other which you would want to bring to the table?
Yes, that's a great question. I think that probably the biggest risk surrounds a hard landing in the United States, consequent upon just how much interest rates have gone up. And certainly we're seeing some pressures on the interest rate sensitive parts of the US economy and financial markets already. We are anticipating a very weak outlook on a forward basis for the US, and to some extent that's actually helping drive investor flows towards Asia, where the growth outlook is much better. But an outright US hard landing that would cause a problem for global growth and also could strengthen the US dollar. And again, the higher the interest rates remain and the longer they remain at high levels, the less likelihood is that the US dollar would weaken from here, which a weakening dollar was part of the reason that emerging markets got up from the floor last October and began to make more progress. But in the Indian context, of course, we must remember that the fiscal position and the current account position are much, much better than they were 10 years ago. And with the oil price relatively subdued, there's not a reason to think that the Indian rupee is at any significant risk, even in this higher for longer US rates environment.
Right. All right, Jonathan, we'll let you go on that one. Thanks so much for joining us with your thoughts on how emerging market scenarios playing out. Where does India is placed in that entire comparison? Thank you so much for your time and have a great conference there.
Thank you.